Okay, class. Now let's finish this chapter. Okay, now let's finish this chapter. In this video clip, we're gonna talk about long-term liability, and specifically, we're gonna talk about bonds. Okay, we're gonna talk about bonds. All right. So what are there are common long-term liabilities, okay? Long-term notes payables, deferred income taxes, and bonds payables. And specifically, we're going to talk about notes payables, okay? So notes payables, bonds payables, excuse me, bonds payables, okay? So what are bonds? Bonds basically are those financial instruments and that's issued by the governments, state governments, local governments, federal governments or companies for borrowing money from the public, okay, from the public, all right, and then promise to pay a certain percentage of the interest in the future and pay back the principals, right? Okay, those are bonds. Okay, so what does a bond look like? Okay, so basically a paper-based bond look like this. Okay, but now if you're buying bond from the investment market, the secondary market, you really don't receive this piece of paper to indicate that you own number of shares of bonds, okay, but in the old days you will see one of these things when you purchase bonds. Okay, so there are three key elements on a bond for any bonds. Okay, one is maturity date, that is when this bond will become mature, okay, and the company or whoever issued these bonds will pay off the principals and the residual interest, okay. And face value is basically how much they are borrowing from one bond sheet. Okay, for example, here 1,000 United States dollar. Okay, that is the face value. Okay, that is the face value. Also, you can see that is the principal. Okay, principal. And stated interest rate. Okay, what is stated interest rate? That is the interest rate written and stated on the contract, the bond contract. Okay, this is a bond contract paper. Okay, contract paper. Okay, that is similar to your car loan. Okay, so when you purchase a car on financing a car and you're gonna sign a document, a loan document, or you're buying you're mortgaging a house, you have to sign a mortgage contract with the bank or financial institute, right? And you're gonna pay a interest rate. Okay, you're gonna pay interest rate based on the house price or based on the price for the car, right? So whatever the interest you pay, and that is written in the contract, that is called a stated interest rate. Okay, and that is the interest rate you're gonna use to calculate the interest. Okay, that is stated interest. All right, so interest calculation, similar formula. Okay, actually exactly the same formula. And here is 12 over 12. That is because in general, 99% of the case, interest of bonds will be paid annually. Okay, it's not like notes payables that pays different time. Okay, but for bonds, usually 99% of the cases that we're gonna pay bonds interest annually. However, there do have one unique case, that is when the bonds become mature. Okay, it becomes mature. For example, let's say the bonds is matured. Let's say January 31st, okay, and then from the year, then using the calendar year, it's only 1 month, right? It's only 1 month. Then here you're gonna calculate interest payments using the fractions, okay. Oh, one more thing is bond pricing. Okay, bond pricing. This face value is the principal that the money you borrowed for. Okay, however, when the bonds transfer to the secondary market, the bonds pricing no longer is determined by the company or by the issuer. Okay, it's determined by the investment market. Okay, it's determined by the investment market. That means the bond price could go up or could go down, and based off on the interest rate, and based off on the Federal Reserve interest rate, and based off on some other factors. Okay, so bond pricing is no longer controlled by the issuers. Okay, so and then balance sheet reporting of bond liabilities. Okay, so sometimes we can bonds can be issued at a premium. That means the money you receive will be more than the bond face value. Okay, and sometimes bond will be issued at face value, just exactly the same amount that you are claimed on the bond paper, okay, the contract. And bonds issued at a discount, okay, and that means you're issuing, for example, this is $100,000, okay. You have this $100,000 bond, and hopefully that you can get $100,000 because of something that customers or investors will not willing to pay $100,000 for this bond. So you're gonna offer some discount, okay. So offer some discount to attract them to buy your bond, and then you offer then the carrying value become less than the bonds face value, okay. So now if bonds issued at a premium, this is how we report on the balance sheet, okay. Under the long-term liability section, okay, you have bonds payable, okay, premium on bonds payable, and then carrying value, okay. Or you can report simply as net bonds 107 to 60, okay, and ignore these, okay. And then for that, it's just the bonds payable $100,000. And for this at discount, you can also report only this one single line on your balance sheet, which is, and ignore all these, okay. So this is how we two different ways to report bonds liabilities on the balance sheet, but also it depends on whether it's issued at a premium or discount or face value. You're gonna report a different amount on the balance sheet, okay. So what is the reason that bonds could be issued at a premium or at a face value or at a discount, okay. So now let's look at this chart, okay. So this is the relation between interest rates and bond pricing, okay. For example, this is what you bond. If you're issuing a bond, this is how the percentage interest rates you are offering to the potential investors on the market. That is 6%. Okay, no matter what, doesn't matter if my company is have earnings or I'm losing monies. I'm gonna guarantee to pay you 60% based off on your ownership of the bonds. Okay, but what if the bond holders want a 4% market interest rate? I'm not expecting for a 6% rate of return. I'm only expecting 4% of rate of return. Apparently, what we are offering now is greater than something that you can easily access on the market, right? So then they'll become more attractive to the potential investors. Then a lot of people are coming to buy your bonds because you only have a limited supplies. Now your demand is increasing, so definitely the price will go up, right? Will go up. So then it will end up with a premium. But if you only offer 6% and the market interest rate is 6%, which means anything else on the market, investment tools is offering exactly the same amount of rate of return, it's just enough. Nobody is going and there's no more demand, there's no more supplies, there's no less demand, there's no less supplies, so you're just gonna issue that bonds at the face value. However, if the market is offering us 8% interest rate, that means the rest of the investment tools on the market can easily give you an 8% rate of return. Why would I on earth could go back to you to purchase this bond who has only 6% of interest rate? That makes sense? So then your demand will decrease, then the price will go down, which will end up with a discount at issuance. Make sense? All right, so face value example, okay? Receives $100,000 cash in exchange for issuing 100 bonds, and their face value is $1,000. So each bond paper carries $1,000 face value. Now you are issuing 100 papers of bonds, okay? So in total, there's $100,000. So the bond at issue total of face value is $100 million. Okay, so we debit this, okay? we debit cash because we receive $100,000 cash, and then we have these liabilities because we're gonna pay off this bond later. So there will be credit bonds payable for the same amount because we're issuing at face value. And then if we're issuing at a premium, which means we receive more cash than the bond face value. Okay, so we're issuing 100 bonds of $1,000 bonds at a price of $107.26. Okay, the company will receive that much in total. Okay, so now we will record this. Okay, we will record this. We doesn't matter how much is our face value. Now our cash receivement is $107,260, right? So we debit cash for that amount, and then bond payables is only the face value. Okay, it doesn't matter if you're issuing bond at premium or at face value or at discount. Your bonds payable also always is gonna be the face value. Okay, is the face value. Okay, is the face value, because whoever, okay, the reason is that now I'm holding the bond you issued, but later on I'm probably gonna sell it on the market to somebody else who has this interest in your company, right? So then I'll transfer the ownership of the bonds to the other person, but it doesn't matter how much I sell it to that investors on the market. At the end of the day, when your bonds come to mature, he is the person who comes to you and with the bond to claim the value on the bonds. Okay, so it is still your liability to pay off that bond face value when it's come to mature. So that is why the bonds payable always going to be recorded at its face value. Okay, and then we need to balance the difference. Okay, on the debit side, on the credit side is premium on bonds payable. Premium on bonds payable, which is $7,260, and this amount will eventually be amortized. Across the life of this bond. How we do it? Don't worry about it. It's not gonna be the topic of this chapter. Okay, but you need to understand that you need to have a separate journal, separate entry to record the difference between the cash receivements and the bond face value. If we're receiving more, it's called a premium. Okay, and now it's come to discount. Okay, it's come to discount, and for those $100,000 bonds, now we only receive $93,376. Okay, the cash equivalent amount is that much. So it doesn't matter how much our face value is. At the end of the day, we only receive that amount of cash. Then we are going to record debit cash for that amount. Remember, our bonds liability always going to be our face value. Okay, and then to finish this journal entry, we have to make it a balance. Okay, and because we offer it at a less price than the face value, and that is called a discount. The difference is called a discount. Okay, how much is the discount? Will be the difference between the face value and the amount of cash we received, and then that is $6,624. Okay, and now we record this debit cash, discount on bonds payable, and then credit bonds payable for $100,000. Okay, so when we issue bonds at premium, we have something on the credit side. It's called a premium on bonds payable, right? But when we issue bonds at discount, we have something in a journal entry on the debit side called discount on bonds payable to fill out the difference between the cash received and the face value. All right. Again, discount on bonds payable eventually will be amortized over the life of the bonds. How do we do it? No worries about that in this chapter. Okay. Also, in future chapters, you will not learning this. Except you are going to the intermediate class, financial accounting class 307 or 308, or in your investment class or finance class, you will learn about those premium and discounts. Okay, and interest on bonds issued at face value. Okay, and the total face value is $100,000 again, and an annual interest rate, stated interest rate is 6%. In cash, okay, that means we'll be paid in cash on the last day of each year, and the General Mills will need to accrue an expense and liability for interest at the end of each accounting period. The end of first accounting period is January 31st, which means even though we are paying all these cash interest annually, but because we have to prepare monthly financial reports, okay, we have to accrue all these interest expenses monthly. Okay, we have to accrue all these interest expenses monthly. So, principal, annual interest rate, and 1 month of a year. So that gave us $500 interest for a month. And then we make these journal entries: debit interest expense $500 and credit interest payable $500, and that is accrued expense, right? And here, interest on bonds issued at a premium. Okay, interest on bond at a premium, and this is called premium amortization. Interest expense is how much? Okay, so will interest expense paid minus the premium amortization. Again, since you are not going to learn how to calculate premium amortization, you will not learn how to calculate interest expense when we issue at a premium or when we issue at a discount. Okay, so don't worry about the calculation as long as you know the journal entry. Okay. All right. Bond retirement. Bond retirement. When bonds come to mature and bonds retired, that means we need to pay off the principals to the owners of the bonds, and the residual of the interest expenses haven't been paid yet. Okay. So now just the principals. Bonds were retired on a payment equal to their $100,000 face value, and analyzed recorded transactions will be out-of-pocket cash payment $100,000, and reduce the liabilities of bonds payable $100,000, right? So again, probably your question is, when it's come to less than a year, when the maturity days come to less than a year, then do we move that into the current liability section, or we just stay that in the long-term liability section? Doesn't move it. Okay, we are going to move that into the short-term liability section. Okay, because the maturity date come to less than a year. Okay, and that's by definition anything that you need to pay it off by within a year, that has to be short-term liabilities. So we have to make the adjustments on the location on the balance sheet. Okay, all right, keep that in mind. And early bond retirement. Early bond retirements have three financial effects. The company pays cash, eliminates bond liabilities, and reports either a gain or a loss. Okay, either a gain or a loss. And I think the last one, the number 3, item here, that is more important than the other two, right? So why companies will retire the bonds earlier than its promised date? Because like people will refinancing their house or refinancing their car, either they find that current interest rate is lower than the original interest rate, or that you have enough cash to pay that off and then for future use somewhere else, right? So there's no need for you to incur actual costs for using the money they lend to you. Okay, so here, assume that 10 years ago General Mills issued a $100,000 bond at face value. If the company retired the bond now at a bond price of $102, General Mills would pay a total $102,000 to retire the bond. Why we have to pay more than the bond face value? Because you have to give a little bit incentive for them to early retirement. Otherwise, later on when you're issuing other bonds on the market, the investors on the market will lose confidence in your company because you're not keeping your promise. That makes sense? Okay. So in this case, we are offering 102 for the bond for early retirement. Okay, so cash payments is $103,000, and carrying value is $100,000. So we are losing $3,000 on his retirement. Okay, so the journal entry will become bonds payable, liability reduced, $1,000. Oops. Again, this is not correct. Okay, what is wrong with this PowerPoint? Okay, That will be $2,000. Okay, don't be confused. Okay, cash received is $102,000. Carrying value is $100,000. Loss on retirements then is $2,000. Okay, then we have this journal entry. We paid off, and by paying extra amount of money, so our cash reduced by $102,000. Crediting that, and debit. Bonds payable, liability reduced by $100,000. The bonds are being paid off, and then again the difference is loss from the bond retirement. So there will be loss on bond retirement. And theoretically, to balance this journal entry, it is on the debit side, right? It is on the debit side. Okay. And that is for bonds. And now let's look at some, let's work on some examples, okay? Let's work on some examples. Discard. Okay, here. So, computing and reporting liabilities at issue price of 73, okay? 97. So, the company plans to issue $500,000 10-year 4% bonds. Interest is payable annually on December 31st. All the bonds will issued on January 1st, 2009. Show how the bond will be reported on the January 2nd, 2019 balance sheet if it's issued at $97 per share. Okay, $97,000 per share. Okay, and here, okay, number 9. So basically, how many shares of bond we issued, right? How many bond we issued, and normally the face value per bond is either $100 or $1,000. $100 or $1,000. Okay, $1,000. Okay, $1,000. So we can look at it, and that is because we're issuing at $97. The selling price is $97, so it's $100 bound face value per pound. Okay, per pound. And how many shares we issued? Okay, $500,000 over $100, so we issued 5,000 shares of bonds. Okay, 5,000 shares of bonds, and each share we sell it at $97. Face value is $100, so we are selling at discount of $3 per share, and times 5,000 shares. 5,000 shares in total. We are offering discount of $15,000, right? So on the balance sheet, on the long-term liability section, okay, we will have bonds payable for $500,000 and discount on bonds payable for $15,000, and then that's carrying value or net bonds for $85,000. Okay, or you simply just record as long-term liability net bonds for $85,000. That is okay. So either way, okay, either way, 1 or 2, okay, either way, that okay. Okay, so this is how we record this. And how do we record journal entries? Go back to your PowerPoints. Okay, use the same journal entries to record the journal entries. Okay, And here, compute and report a bond liability pricing a price for 102. So that is a premium, right? That is a premium. Okay. Again, the the face value is $100. Okay. And now the price is 102. Okay. And it's 50,000 shares. And each share premium is 102. The selling price minus 100 is $2. Okay. $2, and the total premium is $2 times 50,000 shares. That is 5,000 shares. 5,000 shares. 5,000 shares. So in total, the premium is $10,000, right? So on the balance sheet, in this case, we'll report the long-term liability and bond payable, which is again the face value, $500,000. Okay, $500,000. And what else do we have? Instead of having a discount, we have a premium, which is $10,000. So net bonds is $510,000, right? Either report this on your long-term liability section on the balance sheet, or just this part, right? Or just this part. Okay, either one that works. All right, so that is the example in class practice. And now let's go back to the PowerPoints and finish the rest of the topic. Okay. So contingent liabilities are not those actual liabilities we have to pay it off in the future. Those are potential liabilities. Okay, those things has not been happened yet. Okay, so then if we have those potential liabilities, and still we need to let our investors or the potential investors on the markets know, and how do we report that on the financial statements, right? So it depends on the situation of those contingent liabilities. Okay, it depends on how likely is the liability. If it's probable, can the amount be reasonably estimated? If it's yes, then we're gonna record liability and estimate loss. An example will be debit legal expense and credit accounts payable, and whatever the estimated amount you have will be this, and then record it in your regular financial statements. Okay, if it's probable, okay, more than likely, but you cannot estimate the amount. Okay, we just disclose this in the financial statements notes. Okay, we are partially undergoing some legal issues, and then probably gonna have some adverse effects. Or if it's reasonably possible, okay, which means it could happen, could not happen, 50%. Okay, still disclose that in the notes, financial statement notes. If it's remote, it's less likely to happen. Let's say 20% likelihood or 30% likelihood. Don't worry about it. You don't have to report everything to your investors. Okay, and calculate and interpret a debt to asset ratio and time interest earned ratio. Okay. And don't worry about this, okay? Less likely you're gonna have that in your homework, okay? So far that is for chapter 10. Any questions you have, please let me know by sending me emails or post your questions on the discussion forum on the Blackboard. Okay, don't hold your questions until a later date. Until it comes to your homework or quiz or the final exam. Remember, final exam is comprehensive. All right, you not only need to know about the current 4 chapters, but everything from the prior chapters. Okay, so any questions you have, you are welcome to ask me. All right, have a good night.